Hello and welcome to www.multifamilystrategies.com. My name is Steve Steadele and today we'll be talking about cap rates. I have three objectives during this short video. First, to define the meaning of a cap rate. Second, to show you why cap rates vary so much from market to market. And finally, third, I'll share with you some of the biggest challenges and traps investors face when working with cap rates. So what is a cap rate, which is short for capitalization rate? A cap rate is a measure of the ratio between the net operating income produced by an asset and its capital cost. Many people believe the cap rate is the return you get if you paid all cash, and that's true. But the reality is, most investors don't pay cash. They finance the acquisition, sometimes from multiple sources. As investors get involved in the apartment business, they hear the term cap rate from other investors and real estate brokers. A cap rate measures the performance of an asset, and it's a quick and easy way to determine value, if it's done correctly. So let's look at how the cap rate is calculated on an apartment building. First, we must calculate the NOI, or net operating income, by subtracting vacancy and operating expenses from the income. Income less vacancy less operating expense equals NOI. To determine the cap rate on an investment, divide the NOI by the price. For example, if the NOI on a property is $98,342 and we buy the building for $1 million, the cap rate is 9.83%. Many gurus teach that you should buy a property at a 10% cap rate or better. There are a few reasons for this. First, it's an easy number to train people on. Suppose the NOI for this example was $100,000 instead of $98,000. That means we'd have a cap rate of 10% instead of 9.83%. Buyers want high cap rates and sellers want low cap rates. I can't even begin to tell you how many investors I've talked to over the years who told me they wanted a 10% cap rate. Sometimes that was good for them, and sometimes that was bad. Let me explain. Cap rates vary not only from building to building, but also from location to location. There are 5 different types of real estate markets: premium, growth, stable, cash flow, and poor markets. A premium market is a market where your primary return is appreciation. It's a high growth market with rapid appreciation and requires a higher down payment to break even. Some investors define appreciation as speculation, and there is some truth to the fact that when you buy in an appreciation-driven market, such as Southern California, New York City, or Seattle, you're really buying on what you believe the market will do in the coming years. Premium markets normally offer investors solid employment growth, especially in the export sector. A growth market is a market where you have a lot of commerce and migration. It has good growth and requires a moderate to high initial investment to break even. A stable market has slower growth and requires less money. A cash flow market is a market that requires minimum money down, but appreciation is slow. Most of the country is a cash flow market, which is another reason many gurus teach 10% cap rates. Finally, a poor market is a market that lacks the economic influences to justify making an investment. It's important not to confuse a poor market with a market cycle. A poor market is the type of market that will take 10 to 15 years to correct. You should become a cap rate expert, and here's why. There are challenges when working with cap rates. Over the years, I've had thousands of investors tell me they were looking for a 10% cap when in reality, they didn't know what it really meant. For the remainder of this presentation, we'll talk briefly about the following 3 challenges investors face when it comes to cap rates. First, I'll explain why you don't want to become a cap rate crazy investor. Second, I'll talk about how cap rates are easily and commonly influenced and how it can cost you hundreds of thousands of dollars. And third, I'll help you understand the value of the market cap rate. Many investors are cap rate crazy, especially new investors. In fact, I've met hundreds of investors whose net worth exceeds $20 million, and many of them don't know how to calculate a cap rate. Remember, the cap rate is only one indicator of value. There are several others, such as the gross income multiplier, the dollars per unit, dollars per foot, and cash-on-cash returns. Many investors flock to a property that is advertised as a 10% cap. Just because the property is a 10% cap doesn't mean it's a good buy. There are, of course, many other considerations such as the location and the condition and resident profile, among others. And just because it's not a 10% cap doesn't mean that it's not a good buy either. Today, in some locations, a 6 cap is considered a steal. So know your market, and identifying a great opportunity will be a lot easier. How can cap rates be influenced? Can they be changed? Remember, the cap rate is only one indicator of value. If you calculate the cap rate and it looks good but the other 4 indicators are unsupported by sale comparables, think twice and re-examine the property to find out why. At the beginning of this presentation, we define the cap rate as the purchase price divided by the net operating income. The NOI is the most important number you will ever calculate, but the income, vacancy, and expenses can be manipulated and therefore easily influence the cap rate. When income, vacancy, and expenses are unrealistic, cap rates are dramatically impacted. The income, as represented by the seller or the agent, is normally the annualized current rent roll. That's not to say that the income reflected on an operating statement or a Schedule E will match up. It's just that most sellers and real estate agents will annualize the current rent roll and call it income. I do the same thing and then ask myself, is this realistic? In other words, will the property continue to demand the current rent? Could it demand more? The next step is to subtract vacancy and expenses. I can't even begin to tell you how many properties I've looked at where the agent or the seller listed the vacancy rate and the expenses unrealistically low. In fact, it's more common than not. By doing so, the net operating income is higher and thus the cap rate looks more desirable. A good rule of thumb when underwriting investment property is to keep lender standards in mind. Many investors fall in love with an investment property and, unfortunately, negotiate themselves right into buying a substandard investment. You don't want to be one of them. Remember, you're doing this to make money. What is the value of the market cap rate? Here's yet another example of how a standard cap rate can cost you money and opportunities. Can the market cap rate impact the current value of the property? I've asked that question during many boot camps and other live events, and most people answer no. But the truth is, it can. Let me explain. Suppose we're looking at a 50-unit property with an NOI of $139,500. If the property is located in a 9-cap market, that would make the value of this property $1,550,000. Would you pay more if the property had $10 per unit per month rental upside? Probably not. But what if the property had $50 per unit per month rental upside? Would you pay more then? All things being equal, probably. Of course, you'd consider the cost of getting that extra $50 per month, but the bottom line is the property becomes more desirable because you have somewhere to go with it. If similar properties are selling at 9% cap rates, and you increase the rent by $50 per unit per month, you would increase the value by approximately $300,000. Now what if it costs you just $50,000 to raise the rent? Is the building worth more? Would you pay $1.6 million instead? And before you answer, keep in mind that you're still gaining $200,000 in value if you paid $50,000 more in purchase price and $50,000 to improve the property. Maybe you would and maybe you wouldn't, but there's no arguing that it impacts the buying decision. For more information and other great tips on buying and selling apartment buildings, go to www.multifamilystrategies.com. There you'll learn all kinds of strategies and techniques about apartment investing and receive a free CD. Again, that's www.multifamilystrategies.com. Sign up today.